with life insurance?
The most commonly applied form of life insurance is mortgage life insurance. And the reason for this is twofold. Firstly, our homes are probably the most substantial investment most of us ever make. And our homes are also a very, very significant part of our lives. Now, mortgage insurance can be purchased from the lending institution or through an independent financial insurance advisor. There are substantial differences between the type of insurance that you get when you purchase it through the lending institution or when you purchase your insurance through an independent life insurance advisor. Right off the top, when you buy the insurance from the mortgage lender, you apply and you receive a premium. The premium stays level throughout the life of your mortgage, but the insurance protection goes down as the amount of the outstanding mortgage goes down. So you're paying for the initial amount of insurance coverage, but the actual benefit that would be paid out in the event of a claim is reducing as the mortgage reduces. This form of insurance issued through the mortgage lender is not actually owned by you, which is quite different from purchasing your insurance through an independent life insurance advisor. You don't get to choose where the money goes if claim occurs. The money only goes to the lending institution in the case of the mortgage lender issued insurance. Further, the most commonly applied form of life insurance is mortgage insurance. A couple of reasons. Our homes are our most substantial investment and are a very, very significant part of our lives. Now, when we buy mortgage insurance, we can either buy it from the mortgage lender or we can buy it through an independent insurance advisor. When we buy it from the mortgage lender, there's a few things that you need to be aware of. Now, the first thing is that you buy a policy that has a level premium, but the coverage goes down as the mortgage goes down. The most commonly applied form of life insurance is probably mortgage insurance. A couple of reasons. First thing is that our home is one of our most substantial investments, and our home is also a very, very significant part of all of our lives. Now, when we purchase mortgage life insurance, we can purchase two ways: through the lending institution or through an independent life insurance advisor. There are some very significant differences between the type of insurance coverage that you'll get if you purchase it through the lending institution or from an independent advisor. First thing is that you don't own the contract. The insurance that you get from your mortgage lender is nothing. There are a couple of very, very significant differences between the type of insurance that you can get from your lending institution or from an independent insurance agent. The first thing is that you don't own the contract when you purchase it from the lending institution. The premiums can change, the coverage goes down as the mortgage goes down. You don't get to decide who the beneficiary is. In all cases, the beneficiary is the lender when it's lender issued coverage. If something should happen to you along the way, you should suffer an adverse effect to your health, then you run the risk of losing the coverage altogether. If you transfer your mortgage from one lending institution to another, you run the risk of losing the coverage by being unable to purchase the insurance from the new lender. The most commonly applied form of life insurance is probably mortgage insurance. A couple of reasons. Our homes are a very, very substantial investment and a very significant part of our lives. There are two places that you can purchase the insurance that you want for your mortgage, either from the lending institution or from an independent insurance advisor. Now, there are some very significant differences between the type of coverage that you get when you purchase from the lending institution as opposed to an independent advisor. First thing is that you're issued a policy with a level premium from the lending institution, but the coverage goes down as the mortgage goes down. Level payment, reducing coverage. The next thing is that you don't actually own the coverage. If you buy an independent policy, you own the coverage. It's guaranteed for the rest of your life. The premiums are guaranteed and the coverage is guaranteed. It's up to you as to whether or not you want to keep it. Now, when you purchase the insurance from the lending institution, you could easily lose that coverage, and I've had personal experience with this. If something were to happen to your health, you were to suffer a heart attack or an incidence of cancer, then you would lose the coverage when you renew your mortgage. If you went to move your mortgage to another lending institution because the interest rate was lower, you just preferred to deal at that institution. But if you have the policy through an independent advisor, you own the contract. It can't be taken away from you. It doesn't matter what happens to your health. The next thing is that, and it's probably the most significant thing, is that the underwriting for a life insurance policy normally happens at the time that you apply. But with the lender-issued mortgage insurance, the underwriting doesn't happen until time of claim. Now, what does that mean? That means that the insurance company doesn't decide whether or not they're covering you until you claim. When you buy the policy from an independent advisor, they decide to cover you right up front. Once you have the policy, you have it. With the lender-issued insurance coverage, you don't know if you're actually covered. You won't find out. You may never find out. Your family will find out at the time of claim whether or not the insurance company is going to pay the claim and whether or not you were covered. So then you say, well, what was I actually approved for at the time when I ticked yes or no to that single question on the application at the lending institution? You were approved to pay premiums. The actual coverage is not in effect, and you will never know if it's in effect or not until the time of claim. Now that's a scary, scary proposition, because you're not going to be around to fight that. You're not going to be around to argue what you said, what he said, and what happened. Your family is left in a lurch to try to fight with a lending institution, and will likely not have a favorable outcome for your family. We have a documentary on our website, the link to a documentary, to a CBC documentary that was a marketplace expose done on this exact complication with lender-issued insurance. And I suggest you check that out on our website. And the first 6 minutes of it will pretty much give you everything that you need. It's about 19 minutes long, but check it out. The last thing that people always ask is, or suggest, is that the insurance through the lending institution must be less expensive because it's completely lacking in guarantees. You really don't know if you're covered until time of claim, and then it's too late. It must be less expensive. And the truth is that when our clients come to us, I would say probably, if not all the time, in 99% of the cases, we're able to get them individual coverage with all of the guarantees at a lower premium than what it would cost them to have the lending institution issued insurance coverage. Please check out that video, and please consider